So at the moment, we look at the world and we think that governments are just really struggling to stop spending. In fact, let's face it, they want to spend. Whether that's the UK, whether it's Europe, whether it's the US, they really want to keep spending. Now, that is not an environment where we get materially lower inflation, because the backdrop as well is that we are deglobalizing and we're remilitarizing. And part of that remilitarization is reindustrialization, lots of re's. And so, we're of the opinion, actually, that for markets, we are in a period of okay growth, not particularly low inflation, although low inflation has gone down recently. We think it's going to base shortly and start to move back up. Certainly services inflation is still relatively perky. And we're also in a world of lots of bond issuance because governments need to finance all this expenditure. And net, we think we're going to continue to get very positive, real, that's inflation-busting returns from fixed income. Our investment philosophy is that, particularly in developed market credit, there are lots of price inefficiencies. And so the reason for that is that partly because there's just lots and lots of ongoing issuance. And not all those issuances from companies are actually priced efficiently. And so if we look at last year, for example, in euros, we had 14.8 billion of euro-denominated equity IPO issuance. But in the credit market, we got 1.4 trillion of corporate bonds issued. And that's just in euros. And so within that, there's an awful lot of opportunities. So we think we can work our fund very hard. And effectively, we are optimizing our fund on a daily basis through activity in both the primary market and the secondary market. And the byproduct of this activity, the byproduct of this optimization, is that we're taking lots and lots of small amounts of profit without taking a whole host of credit risk. So this strategy works at the moment, and works quite well at the moment actually, because really what we're getting from the market is a very good, as I said, a positive inflation busting return. That makes the asset class quite attractive. Part of that attraction is that credit spreads are actually compressed, i.e. what we're getting paid from credit over government bonds is not that great. And so in this environment, a very active trading strategy works quite well because, typically fixed income is bought for yield and the yield on offer is very strong. It's just that credit component is quite slim. So there's not much to play for from being a credit beta manager, let's say, and having lots of credit risk. But actually, in terms of the activity and the fact that we can chip away and take lots and lots of small amounts of alpha, that gives the fund an opportunity, I think, in this environment to outperform.